This is Wealth Builders, presented by Staten Walsh, a show designed to pull back the curtain of the financial industry and bring true transparency to the forefront of conversation. On the show, we cover topics like financial education, current events, and interview business leaders and industry experts with the ultimate goal of helping listeners discover their own path to financial independence.
Welcome, everybody, to Wealth Builders. Excited again to be here with you today with my partner, Ryan Staten. Ryan, I already hate this podcast that we're about to do today. I hate it because we're going to be talking about Tom Brady and how he compares to long-term investing. As a Ravens fan, I know you are. I know I am. It's been a thorn in our side for years. Man just won his 7th freaking Super Bowl. Does he ever want to retire? I don't know. But today is all about how I can't believe we're doing this, honestly. But how does Tom Brady relate to long-term investing? I don't even want to talk anymore, so I'm just
What do they have in common? Well, when we were coming up with this, we've been having conversations with people about long-term investing and consistency, and unfortunately, it's obviously we like to have timely episodes or things that are relevant to what's going on. And obviously, most people out there who pay attention to sports know that the Buccaneers won the Super Bowl, and Tom Brady was their quarterback. So, there's something to be said. Obviously, 7 Super Bowls, it's something. And it was an unfortunate parallel. I'll say that. It was one of those things that I was trying to come up, obviously we like to make this conversational. We want this to be relatable to everyday stuff. And that was just something that was like, damn, it sucks, but at the same time, it makes a ton of sense.
Yeah, you gotta admire it. It's one thing after another. It's a regiment, and it's just, he does it day in and day out. And, it's at least all the success.
Yeah, so the interesting thing about it is obviously when he went to the Tampa Bay Buccaneers, they were a 7-9 team, I think like 3rd in their division last year. Not the worst team in the league, but obviously not the best. And then all of a sudden you turn around and add a couple pieces to the puzzle, but ultimately that big piece was Tom Brady, and he ended up being a big influential part of obviously them winning that Super Bowl. And there's a lot to be said about that, and there's a lot of life lessons to be learned and a lot of parallels. And if we were going to talk about long-term investing, there's not many examples out there that are better, to be quite honest with you. I mean, it's one of those things that, as much as it pains me to say, he's consistent, is one of those things, one of those people that every year I'm like, God, I just wish he would go away so someone could win the Super Bowl. But at the same time, you can't be mad at the work that he does. I mean, it's incredible. So, in terms of today, what we wanted to talk about was long-term investing and why consistency matters, and why, in today's world, flashy, it gets all the hype, the big hits, whether we're talking about investing, sports, whatever it is, like the big money goes to the flashy, the big name, big play guys in sports, so to speak. And the same seems to be true in investing. One of the things we talked about in one of our previous episodes was how the world has kind of opened up and people have been more engaged in investing. But at the same time, people are trying to take that shot to try to get the big pops, the GameStops and all the meme stocks of the world and what happened there. People are craving that. They want to see that happen. But the reality is that, going back to our analogy, as high-powered and as historic as the Kansas City Chiefs offense was, it boiled down to the guy who's won half of the Super Bowl. He's won the Super Bowl half the time he's played in his career, appeared in the Super Bowl, and he's won it a bunch of times since he's been there. It all boiled down to the consistency, the, not super flashy, but gets the job done player. It's not the guy that can throw the ball 100 yards down the field. And I think the same tends to be true with investing. You have your core foundation to your portfolio, and then you have these, we call them satellite positions, or these other diversifiers, these these big playmakers that there's a potential they can get a 40-yard, 40, 50, 60-yard run, touchdown pass, whatever it may be. But there's also a chance that they can throw a pick or they can fumble the ball and all of a sudden it's going the other way for a touchdown. So it's a really clean analogy. It works really well. And as much as I know we mutually are not fans of Tom Brady, unfortunately, he made his way onto the podcast early on.
Yeah, it's a shame, but I think it's a great analogy. So when we talk about like some of these, a lot of people talk about, like, for example, like when like the meme stocks right now, like with the red and everything, everybody wants to, I want to get that quick 50, 60, 7% pop and get out of the market real quick. The sexy investments. I've had friends message me before, say, hey, I feel like I'm missing out on this stuff. I feel like everybody's making money but me. So obviously the media and Wall Street wants to put these things to the forefront to get people excited and all that. But so how do those kind of, relate to the ultimate game plan around all the players and all the pieces, not just the flashy, maybe wide receiver or running back that runs a 4.3 40 in perfect size and Heisman winner. But how is that compared to, the offensive line? What are the things that's important, like the stabilizers in your portfolio?
Yeah, it's all about having systems, right? I mean, every year everyone has the same goal. In sports, in life, you want to be successful. You want to have a positive gain, positive rate of return. You want to win a Super Bowl. Those positives, they need to translate into having a system and process around how when you get up every day, what are your goals? What are your objectives? What do you want to work towards? And understanding what that is and creating it out. We're not talking about, obviously in life, we don't wake up every day with this like neurotic sense of I got to check my boxes today just to have a day of success. But over the long term, when you look back, you get to December 31st and you look back on your life, your sports, your investment portfolio, was it successful? So building a process or a system around that is different for every person, right? We're all the general managers of our own finances, our own clubs. And so creating that system is the first step, understanding what your end goal is and understanding what pieces are necessary to get you there. If you're a team that doesn't have a lot of success, like you might take a couple shots, you might try to get that big name player or somebody in there that maybe is not super consistent, but has a potential to get you somewhere that you normally haven't been. And, sometimes that works and sometimes it doesn't. And that's the same in investing. What we find, and not just with this particular analogy with Tom Brady, but in other sports, is that there's a ton of people out there that spend big money for these big name superstars or, in investing, we put all of our money, we concentrate it in certain places to try to ensure that we're going to get that upside or that gain. And what ends up happening is you get a really expensive, overweighted portfolio that may not yield the same as, for example, let's go to baseball. We're both baseball guys. Tampa Bay Rays last year. Yep. System organization, don't spend a lot of money, make it to the World Series. Now, they lost to the big money team, but the point is that teams like that, it makes you wonder, I guess is the point, is when you see things like that in life that happen where, another great example, but finishing my point, when you see things like that happen in life and investing, whatever it is, you always wonder, like, why did I waste all that time going shooting for the moon, not to stay relevant here, but why am I wasting all that time when all I could have done is do, the singles and doubles, so to speak, the basics, the foundations, the fundamentals. Had I done that, I would have been just as good or even better. And so it definitely raises it plants a seed of doubt. It raises a lot of questions. And so ultimately we want to just we want to bring that to light and say, hey, here's how we can create an environment of consistency, of still achieving your goals, but maybe not trying to go too far outside the box.
Yeah, I think it comes down to game plan. A game plan is different for everybody. It could be two 30-somethings who make the same exact amount of money and the same job title are identical, but they might have completely different game plans for how the ways they think about money, the way they think about investing, the way they think about everything in their life. You're not gonna have the same game plan if you're the offensive coordinator for Tom Brady as you would with Lamar Jackson. Completely different games, completely different game plans. So I think that's extremely important too. Not everybody has to have that same mindset and the same game plan to get where they need to be. Some people like to take more risk. Some people like to take less risk. So I think that's important as well.
Yeah, so I mean, another way to make this analogy or to talk about is there's a huge study that happens every year on the market called a Dalbar study. And if you Google it, there's other places where you can get access to that. We could probably even put a link in the show notes to, there's one in particular that we look at a lot, JP Morgan Guide to the Markets. They come out with it quarterly, really nice publication. It's long, fair warning, but there is a piece in there about investment principles and principles of investing. And it incorporates the study, the Dalbar study that I mentioned, and it talks about 20-year periods of time. So what it looks at is what do different asset classes do? So when I say asset classes, you look at equities, stocks, fixed income, bonds, real estate, international companies, international large, developed, emerging markets, a couple of different asset classes, and then it pulls in a major index like the S&P 500. And what it does is it looks at the rolling averages of those 20-year periods, and it tries to figure out like who did the best, who's number one basically. And what we've found, or I guess what that study has found, is that the average equity investor usually yields about 2.5%, or has recently, based on the most recent 20 years, about 2.5% annual return in the market versus I think home prices have appreciated at a greater rate than that, just a little less than 3%. Inflation is like just around that same number over that period of time. So you're basically keeping up with the cost of living adjustments over time. So why is that? I mean, really what it boils down to is investor behavior and bringing home our sports analogy. Every couple of years, you do a rebuild. Say, this isn't working and I want to try something different, and you do it over again. And so what that creates is inefficiency. Another interesting piece of that chart that I saw recently when we were looking at it was the S&P 500 was just a little less than 6%, I want to say. Mm-hmm. But then a 60-40 portfolio. So what we mean by that is 60% equity, so 60% what would be deemed more risky investments, 40% fixed income, which are slightly more conservative. Over the past 20 years, the 60-40 has only underperformed the S&P 500 by, less than 0.5%. That money does add up over time, but I guess the point we're trying to make here is you can sometimes take less risk. You can go with your steady, foundational approach that not flat. You don't have to get too flashy sometimes to achieve the same goal. So in that scenario, the S&P 500, obviously, for those of us that remember 2008, 2009, big swings in the market. We've had a couple other bumps along the way. There was a lot of up and down, and that's usually what initiates some kind of behavioral change or wanting to swap things out. And, if you had just stayed the course, you would have been fine. Obviously, you would have finished ahead. But if you're doing this swapping in and out, you end up more like the average investor, which is you don't get much for all this activity. And so the point to be made there is sometimes consistency is better for the average everyday person than getting flashy and trying to get those. It's important to have those pieces to the puzzle because in some years they're what's going to carry your portfolio. But most of the time you want to have your core. You want to have your Tom Brady's of the world that they can quarterback your offense and they can put people in the right places. And if there's an option for a 50, 60, 70-yard touchdown pass down the field, having that player there is important, but you don't want to rely on them for that every time because they can just as well be the cause for you to lose a game, and win a game at the same time. So they're risky. It's a risky play. And that's that's the point we wanted to make, really. And
that's good stuff, Ryan, because it's something that when you talk about making those moves in the market and possibly, underperforming a benchmark when all you could do is just be simple and stay in there. One of the great studies, I believe you said Fidelity did this, some of their best performing accounts they've had have been people who've forgotten they've had accounts at Fidelity and people have passed away.
That's crazy.
It's crazy. It just shows you if you just allow your money to grow and just let it sit there and periodically rebalance and have the right players there over long term and consistently, methodically do what you need to do, it's going to get to the same results, not better. So that study's always fascinated me.
Yeah, it's a conversation around risk, not in the way that you invest your money, but how you react to the way that it's invested, if that makes sense. So it's in a roundabout kind of way. That Fidelity study they did was crazy to me when they said that, but it's also, it's true. I mean, if you think about it, the things that you do, the mindless things in our life that we do, they just become commonplace. I mean, to use another example of how that happens in life, I discovered at one point in time, and look, I'm guilty of it too. Like, I do things that I make mistakes. I was paying a Sirius XM subscription on a car that I hadn't owned for a couple of years, and I had no idea. Like these are just the things that happen. Now, there's positives and negatives to that kind of mindset or those things happening to you. Unfortunately, I was on the wrong side of that. Whoever was driving my car around was, crushing it, having all kinds of sports talk radio available to them anywhere in the country. But for me, I didn't get that, and I was getting double dipped. I had my new car and my old car, but
I was wondering why that went out.
Yeah. Yeah. So, it's one of those things that there's positives and negatives to those things happening. But when you have something that you understand and that you have faith in, and that there's consistency, and you don't have to consistently coach it or micromanage it or do a lot with it. It's one of those things that you pick it, you understand it, you're going to see good and bad. Again, back to our analogy, the whole theme of this show, early in the year, all of the sports pundits were saying, the Buccaneers are doomed. There's, the water's poisoned. Bruce Arians and Tom Brady hate each other. They were supposed to play golf together and they canceled it. And, all people make up things. There's something in psychology called confirmation bias, where we try to digest or absorb information that we believe proves our point. And so that happens in everyday life. It happens in investing. And so, the moral of the story is stay consistent, have your core, have those things that you really believe in and you trust in, and then surround it with a couple extra pieces that are going to give you that extra flair and that extra pop, so to speak, in your investment portfolio potentially. And things that will carry you in moments where the rest of the team is letting you down. But all of it should work together. I mean, it's very much a team, and you got to have the right players across the board. And, you're going to win some and you're going to lose some. And if you understand that and you stick to your system, usually you're going to find success. And so, Tom Brady's career is a perfect example of that, where the guy's been to a Super Bowl pretty much, half of his career, and he's won 7 out of 10 or however many he's been to. And so he's a high probability play. It's someone you definitely don't bet against. And there's a lot of ways that we can take lessons like that and apply it to everyday life.
I agree. And Ryan, all I got to say is I hope this is the first and the last time we have to talk about Tom Brady on this show. That's all I got to say.
I'll be eating my words next year if Patrick Mahomes goes to the Super Bowl and puts up like 60 points, and people will be like, remember that time you did that stupid podcast? Well, you're wrong. Flashy players do that. So, no, it's we love to make it, obviously that's the whole point. And these are good examples and good life lessons to be learned. And I think that for us, it's, sports analogies work because obviously we're sports guys, but we're going to try to do that with everything. I mean, complex, complicated topics, you got to make them fun, or else people aren't going to make it through the first couple minutes of these things. Will be snoozing on us. So
they're probably already snoozing, but no, good stuff, Ryan. Appreciate it. And thank you again, everybody, for listening. Make sure you subscribe on YouTube, Apple iTunes, or Spotify, whichever you listen to most, and have a great week.